In the financial market, there is a famous phrase that often leaves new investors completely confused. Good news is bad news. We will normally think that a booming economy with plenty of jobs is an amazing sign for everyone. But on June 5, 2026, the United States government dropped a major economic report that proved exactly why a strong job market can act like an absolute wet blanket for high-growth assets and high-risk assets. The moment the latest employment data hit the wires, global stock market dipped, bond yields surged, and Bitcoin experienced an immediate sell-off, sliding down to critical $60,000 support level. Today, we are going to break down these macro connections. We will also look at the exact hiring numbers that just came out, explain why this data changes the Federal Reserve's interest rate roadmap, look at the shifting investor expectations, and analyze why Bitcoin historically struggles when interest rates stay higher for longer. To understand the market's reaction, we have to look directly at the fresh data released by the Bureau of Labor Statistics. The closely watched non-farm payroll report revealed that the United States economy added 172,000 new jobs during the month of May. To put that into perspective, macroeconomists and Wall Street analysts predicted a modest addition of only about 85,000 jobs. This meant that the actual hiring numbers crushed early market consensus, completely doubling expectations. Furthermore, the government adjusted the hiring numbers from the prior 2 months upwards by a combined 93,000 jobs, while the official unemployment rate held perfectly steady at 4.3%. In short, the data tells us that the American labor market is running significantly hotter and proving to be far more resilient than anyone anticipated. Now, let us look at why a hot job market makes the central banks, known as the Federal Reserve, much less likely to lower interest rates. The primary mandate of Federal Reserve is to maintain stable prices and keep unemployment low. When hiring is strong and companies are actively competing for workers, wages tend to rise, giving consumers more cash to spend. If consumer spending stays exceptionally high, stores can keep raising their prices, and which keeps domestic inflation sticky and elevated. To understand how the Federal Reserve responds to this, let us use a simple driving analogy. Imagine the United States economy is a heavy car traveling down a highway, and the Federal Reserve is the driver. Inflation is a steep curve coming up ahead. To navigate the curve safely without crashing, the driver needs to press down on the brake pedal. In the financial world, raising interest rates is equivalent of pressing that brake pedal because it makes borrowing money for cars, homes, and businesses far more expensive, effectively slowing down the entire economic engine. Because today's job report proves that the car is still accelerating down the highway despite previous restrictions, the Federal Reserve has zero incentive to take its foot off the brakes. They need to keep interest rates high or potentially even raise them even further to make sure inflation cools down completely. This realization has completely upended investor expectations. At the start of the year, a vast majority of traders and fund managers were confidently planning for a series of interest rate cuts, hoping that cheaper borrowing costs would inject fresh liquidity into the global asset pools, benefiting risk-on assets. Following today's non-farm payroll shocker, those near-term easing expectations have been entirely pushed back. Instead of betting on rate cuts, financial future markets immediately began pricing in a higher for longer monetary environment, with some indicators showing that the probability of an additional Federal Reserve rate hike later this year has climbed significantly. In response to these climbing fears, the 10-year United States Treasury bond yield spiked sharply to 4.54%, drawing massive amounts of capital out of speculative markets and into safe government debt instruments. This macro shift explains exactly why Bitcoin and tech stocks are experiencing an immediate correction down towards $60,000. To understand why Bitcoin struggles in a high interest rate environment, let us use a financial sponge analogy. When interest rates are near 0%, money is incredibly cheap to borrow. In traditional bank saving accounts, pay virtually no returns. Because sitting on cash yields nothing, investors look for alternatives. Extra money flows freely across the economy like water pouring into high-risk assets like tech stocks, startups, and cryptocurrencies to chase high yields. But when the Federal Reserve keeps interest rates high, those elevated rates act like a giant financial sponge. Suddenly, an investor can purchase a United States government bond and receive a guaranteed risk-free return of over 4.5%. When safe, traditional assets pay a solid return, big institutional money managers lose the appetite to speculate on volatile digital assets. The financial sponge sucks liquidity out of the crypto market and pulls it back into safe treasury bills, drying up the extra cash reserves required to push Bitcoins to a new high. The sell-off we are observing today is a clear reminder that Bitcoins does not trade inside an isolated vacuum. Even though the underlying blockchain network is running flawlessly, its short-term market price remains highly sensitive to global liquidity flows and central bank policy, especially with their ETFs. While strong job numbers report is fantastic news for the real-world workforce and also the United States economy, it meant the era of high borrowing costs is staying with us for longer. As Bitcoin finds itself footing around the $60,000 support, long-term investors will be watching to see if the broader economy can naturally cool down enough to let liquidity tap turn back on. Thank you for watching this video. If you find this clean, data-driven financial market reviews valuable, please consider subscribing to the channel to support our work. Share your thoughts on the Federal Reserve and Bitcoin down in the comments below, and I will see you all in our next video.